Hi everyone. After a very long topic of banking, we are coming to another long topic of insurance. Now we're going to talk about insurance. You must have heard about insurance when I talked about the initial first chapter, auxiliaries to trade. Insurance was one of the TIBWAT, transportation, insurance, banking, warehousing, advertising. So insurance was the second point when I framed this acronym for you. Now, what exactly do we mean by insurance and why do we need insurance? See, life is full of uncertainties. We are not sure what might happen tomorrow. We were not aware of this pandemic coming, and because of this pandemic, people falling sick or people losing their lives or spending so much of money on the medical aspect of it, and people all of a sudden started taking insurance policy to cover their risk. Now, what exactly is insurance and why do we take it, and which are the parties involved in insurance, what is insurance policy, what's an agreement, and how we pay premium. There are few things which we must know first about insurance, and then I'll let you know what is the fundamental or basic principle about insurance. But one thing is for sure, risks cannot be eliminated. You cannot eliminate risk. They are bound to happen. There are unforeseen circumstances. There may be an earthquake, there may be a kind of any kind of unforeseen event. There could be a flood, there could be some kind of maybe accident or a fire or a breakout at your house or anything like that. People do have uncertainties in life, but these uncertainties can only be covered through insurance. You cannot eliminate the uncertainties, you cannot eliminate the risks, but yes, you can just simply reduce the magnitude of the loss which you're going to suffer. So basic thing about insurance is that it tries to cover or compensate you for the loss which you have suffered because of unknown or unforeseen circumstance or event. So in order to cover that unforeseen event or a particular loss, what you do is you pay a small amount as premium. Once you pay a small amount as premium, what is a premium? That is the certain percentage of the total thing which you are getting insured and the number of years it has been used, that is a depreciated value. We keep that into consideration. So after keeping that into consideration, once that particular asset is valued, and you pay a small amount as premium, as some percentage of it, so that in case if you incur loss, you are compensated for the same. So that is what insurance is all about. Now, what is the basic fundamental about insurance? The basic fundamental principle about insurance is that let's suppose there's a group of 10 people. One person takes insurance. Now, there are 9 other who also take insurance. It is not 100% that all 10 of them are going to bear a loss immediately after or simultaneously or immediately. So it may happen that one person suffers loss and 9 of them don't suffer loss. So what happens is that one person who suffers loss, the insurance company does not pay from its own pocket. It doesn't pay from its own pocket. The premium these 10 people have paid, from those 10 people's premium, this person is compensated for the loss. And also the risk gets what? Widespread. The risk gets covered up with 10 people. So insurance company does not end up paying anything from its own pocket. What it does is it makes all the people who were involved to pay for the loss. Next year maybe another person bears a loss, but next year again these 10 people will take new policy, they'll pay the premium, and again, and this process keeps on continuing. Sometimes nobody incurs loss. So what insurance company does, from that premium they put that money into investment purpose, and some or the other kind of investment is done probably in mutual funds or in different kind of investment opportunities of the companies. So what happens is, what is the basic fundamental principle about insurance? The fundamental principle about insurance is that the risk is spread over a lot number of people. One. Second, insurance company doesn't have too much of expenditure to incur on it. In case people take a policy which is for a longer period and they keep on paying premium, so that premium gets accumulated and that can easily be kept for the capital formation or investment purpose somewhere else. And the best for you is that once you take insurance, you get protection against all the odds which are covered in the insurance policy. So let's start with insurance. What exactly is insurance? Insurance is a device by which loss likely to be caused by uncertain event is spread over. We are spreading it over a number of persons who are exposed to it and who prepare to insure themselves against such an event. So basically, this is a fundamental principle, this is a definition also, and this is how insurance is defined or explained. Then it is a contract. Contract is like when you when two parties are there and they mutually agree on something and there is a legal enforcement about it. When it is enforceable by law, it becomes a contract. So it's a contract or agreement under which one party agrees in return for consideration. Now what's consideration? In a simple language, consideration is mutual give and take. Mutual give and take, I pay you my premium, you give me, you just compensate me for my loss. So consideration to pay an agreed amount of money to another party to make a loss, damage or injury or to something of value in which insured has pecuniary interest. Now what is pecuniary interest? Pecuniary interest is monetary interest as a result of some uncertain event. So in case you face any monetary loss because of some uncertain event, of course, that will be covered by insurance. It will be widespread. Why? Because all people are paying premium. Your loss will be compensated for, and this is a written agreement which shows that yes, you will be compensated for. So it's a contractual agreement under which one party agrees in return for a consideration. We are paying premium. This party, one party is who? The insurance company. They agree for consideration, the premium we pay, to pay an agreed amount of money to another party to make a loss, damage or injury to something of value in which insured has pecuniary interest. In something which I have monetary interest, that will be compensated for. In case there is a loss, of course, I have to keep the consideration as well as contract in mind. There are some valid essentials of a contract. When you sign a contract, there are few things which you need to keep in mind. Consideration is one of them, and contract is something which is legally enforceable. It is an agreement which is legally enforceable, one. And second, it talks about consideration. Consideration means what? Mutual give and take. So that should be there. This is what a contract of insurance talks about. Next, we need to know what is an insurance policy. Since we've talked about the agreement and the contract, the agreement or contract is put in writing is known as policy. So when it's written, when agreement is enforceable, it becomes a contract. When that contract is given in writing, it becomes a policy. The person whose risk is insured, the person who takes insurance is called insured. The firm which insures a risk of loss is known as insurer. The insurance company is known as insurer. So this is the insurance company. When you talk about insurance company, it is known as insurer. Now, what's an insurance company? It is an association. It's an association. When we talk about corporation, okay, fine, or an organization engaged in the business of paying all legitimate means legal claims that may arise in exchange for a fee known as premium. So the fee is known as premium which you pay, and when you try to get compensation for that, the party that provides it, the company that provides, is known as insurance company. It's an association, group of people, organization, corporation, business, and of course all legitimate legal claims will be made properly paid for. What's a premium? Is a small periodic payment for risk of large possible loss. It's kind of a fee which we pay, which the insured pays to insurer, right, for covering the risk, right? So you can write it like that: fee which insured pays to insurer for covering the risk, that's known as premium. And what is the fundamental principle? I've already talked about the fundamental principle. The basic principle of insurance is that an individual or a business concern chooses to spend a definitely known sum. So you know what you're spending, that is your premium. This is known sum, is nothing else but your premium, you know, in place of a possible huge amount involved in an indefinite future loss. So you know that there's a possibility of loss, 100% there's a possibility of loss, or maybe there's a possibility of loss. 100% to nahi keh sakte, we can't say 100%, but in case there's a possibility of loss, we will be compensated for that. The loss of risk still remains it still remains, but the loss is spread over a large number of policy holders exposed to same risk and same people. When we talk about insurance, what we have to do in our syllabus is the 3 types of insurance. First is life insurance, second is fire insurance, and third is marine insurance. So when you talk in terms of life insurance, now life insurance is usually for a very long time, 5 years, 10 years, 20 years, 30 years, and fire and marine insurance are for 1 year or for one voyage. So after that 1 year, once you get your house insured for fire and there is no loss, what happens? That policy lapses, you have to buy a new policy. But in life insurance policy, that continues till the time you've agreed upon. So that money keeps on getting accumulated, and that money is spread over a lot number of people, and that's how insurance companies operate. So when we talk about spreading of the risk over large number of people, people buy invariably different types of policies. They buy health policy, they buy life insurance policy, they buy fire insurance, they buy marine insurance. They take so many different types of insurance policies, and you don't have to pay everyone at the same time. And insurance company has a widespread network. So that is why even many of our banks are switching over to this business of insurance. Why? Because they're finding a lot of revenue generation out here and a lot of future prospect of future growth. To continue with the lecture on insurance, it is very essential to know the functions of insurance. Though these are not broadly in your syllabus, but if you do not know the functions of insurance, you would not understand that why people like to actually insure. What benefit does the insurance company get, or what benefit do the people who take insurance get? What is the fundamental behind it? So we know the fundamental, the basic principle that the risk is widespread. But what does the company do? What benefits does the company derive out of it? So the first is insurance provides certainty to the person who takes insurance. Why? Because 100% in case if there is a loss, he will be compensated for. If it is asset or property, he will be compensated for. If it is life insurance, he'll for sure, assurance will be there that either at the time of his death to his nominees the money will go, or the money will go to him once that tenure for the life insurance gets over. So insurance provides certainty of payment for the risk of loss. There is a certainty out here, risk of loss is out here. There are uncertainties of happening of time and amount of loss. We do not know one thing may happen. Insurance removes these uncertainties and assured receives payment of loss. Now assured is a person who takes life insurance policy, so 100% he will get payment. If he dies, his nominees get it, but if he is alive, then in that case he will get that payment. So there is a certainty that risk will be covered. See, you cannot eliminate risk, but you can of course cover up the uncertainties through insurance. The next point is protection. When you talk about insurance, it provides protection. So you're mentally prepared, you're 100% sure that once you're taking an insurance policy, your risk will be compensated for, your loss will be compensated for. So insurance provides protection from probable chances of risk. So there's a probability that the loss is going to happen, or the risk is going to take place, or there was going to be a uncertainty. We're not 100% sure about that uncertainty. In case nothing happens, good enough, only small amount of premium went. But in case loss occurs, then you're actually indemnified, you reach to the same place where you were before happening of the event. So insurance cannot stop the happening of the risk or event, but can compensate for losses arising out of it. So there is a compensation for the loss. Next we talk about risk sharing. So this is the same as the basic or fundamental principle that risk is widespread among different people who pay their premiums. So on the happening of the event, the loss is shared by all persons exposed to it. The share is obtained from every insured member by way of premium. So the premium which you pay gets compensated for, the risk gets shared by all people, and of course we know it. Many times I'll keep on repeating it, I'll keep on telling that all the people will not have the same kind of loss at the same time. So risk is basically shared. Assistant capital formation. Now the accumulated funds of insurer received by way of premium payments made by the insured are invested in various income generating schemes. The insurance company which gets money actually invests the premium money If they don't have to compensate anybody, they invest the same money in mutual funds or buying shares of different company. That is the reason why many banks have started this new generation or new times business, that is to do with the insurance. So that's all for this introduction of insurance. We'll cover up the principles and then we'll go ahead with the types of insurance as well as the elements of insurance. Bye bye.